Have you ever been caught in a strong uptrend, feeling excited to join the move? You carefully place your entry, set your stop loss and target, confident the market will go in your favor. But then, the unexpected happens, the market pulls back, hits your stop loss, and then takes off in the direction you predicted. That's what we call getting trapped in a pullback. In this video, I will show you exactly how to spot pullbacks before they even happen, and how to trade them profitably using a simple price action trading technique. Before we dive into trading pullbacks, it's crucial to understand the foundation, the three main types of markets. Recognizing which market type you're in will make spotting and trading pullbacks much easier and more effective. In an uptrend, prices move higher because buyers are in control. There are two key moves: the impulsive move, where prices push up; the retracement, a temporary pullback as buyers take profits. Think of it like a quick breather before the price continues to climb. This pullback is your golden chance to hop on the trend before the next big move up. In a downtrend, prices move lower because sellers are in control. There are two key moves: the impulsive move, where prices drop; the retracement, a slight bounce as sellers take profits. This pullback is your opportunity to join the downtrend before the next drop kicks in. In a range-bound market, prices move sideways, trapped between a high and a low point, with neither buyers nor sellers in control. Pullbacks in this scenario can be tricky, as trading within the range is generally not advisable. The best approach is to wait for a breakout, when the price moves decisively above or below the range. Once the breakout happens, look for a pullback to confirm the new trend direction. This is where the real trading opportunity lies. One of the biggest challenges for traders in an uptrend is figuring out exactly when the pullback ends and the next move upwards begins. Through my analysis, I've identified 4 key levels where pullbacks often stop. Let's begin with the most common one: support and resistance. Let's break this down with a clear example. Here we're looking at a strong uptrend. You can see the market moving in waves, making impulsive moves upward followed by retracement moves or pullbacks. In this case, the price broke through a resistance level and then pulled back toward that same level. Now something critical happens. The previous resistance level becomes support. As the price approaches this new support level, it finds buyers stepping back in, and the market starts moving up again. In an uptrend, support levels act as reference points. When the market pulls back to a support level, it often signals the end of the pullback and the start of a new upward move. By identifying these key levels, you're able to pinpoint exactly when the pullback is likely to end, giving you a clear signal for your next trading opportunity. In a downtrend, pullbacks often end at previous support levels that flip into resistance. Here's how it works. The price breaks below a key support level, and when it pulls back, that same level now acts as resistance. Sellers step back in at this point, rejecting the price and driving it lower again. You'll see this pattern over and over in downtrends: a pullback to a resistance level, followed by another leg down. By spotting these pullbacks in a downtrend, you can identify solid entry points to stay in line with the overall market trend. Now let's move on to the next level where the market often pulls back: the trend line. Trend lines are a fantastic tool for spotting where pullbacks might end and the trend might continue. Let me walk you through how to use them. First, when you spot a trend, let's say a downtrend, you'll draw a trend line connecting the lower highs. For example, in this chart, we see the price rejecting the same angled line multiple times. That tells us it's a valid trend line. Next, notice what happens as the price moves. It pulls back toward the trend line, rejects it, and then continues downward. This pattern repeats. The price pulls back, touches or comes close to the trend line, and then moves down again. What's the takeaway here? A trend line acts like a guide, showing where pullbacks are likely to end. If you can spot these pullbacks to the trend line, you can pinpoint potential high probability entry points in the direction of the trend. Let's move to another powerful tool for identifying where pullbacks often end: the 50 Simple Moving Average. This is a favorite among traders because it helps pinpoint areas where the market might reverse after a pullback. Let me show you how to use it effectively. The first thing you need to do is add the 50 Simple Moving Average to your chart. This moving average acts as a dynamic support or resistance level, depending on the trend. In an uptrend, it often acts as support, where the price bounces and continues higher. In a downtrend, it works as resistance, rejecting the price and pushing it lower. Now let's see how the market interacts with this level. During an uptrend, the price often pulls back to the 50 simple moving average, finds support, and then continues its upward movement. Here's why this happens. The 50 simple moving average isn't just a random line. It represents the average price over time, and because so many traders and institutions watch it, pullbacks to this level often lead to strong reactions. If you can spot pullbacks that align with the 50 simple moving average, you're identifying key areas where the trend is likely to resume. And here's the best part. When you combine the 50 simple moving average with other tools, like support and resistance levels or trend lines, you create a high probability setup with even more confidence. Now let's dive into one of the most powerful tools in trading, the 50% and 61.8% Fibonacci retracement levels. These levels are like magnets for price action and can help you pinpoint where a pullback might end and the trend is likely to resume. Let's break it down step by step. The first thing you need is a clear trend. In this example, we'll focus on an uptrend, where the market is making higher highs and higher lows. This is important because Fibonacci levels work best in trending markets, where your goal is to join the trend, not fight it. Once you've identified the uptrend, grab your Fibonacci retracement tool and draw from the swing low to the swing high. This will plot a series of retracement levels on your chart. Now, here's where it gets interesting. As the price pulls back, focus on the 50% and 61.8% retracement levels. These levels aren't random, they're significant because they reflect areas where buyers often step back in and the trend resumes. When the price reaches these levels, watch for signs of rejection, like a bullish candle or a strong bounce, to confirm that the pullback is ending and the next move up is about to begin. These levels are so powerful because they represent areas of psychological importance. Many traders and institutions use them to time their entries, making them key zones for spotting pullback reversals. Now that you've learned how to identify pullbacks, let's move to the next step: finding the right entry signals. One of the most effective ways to confirm the end of a pullback is by using a liquidity sweep. This is a powerful technique to validate your entry and avoid getting trapped in false moves. Here's how it works on a real chart. The market is in an uptrend, and the price pulls back to a previous resistance level that's now acting as support. Instead of bouncing right away, the price dips slightly below the support level, triggering stop-loss orders from buyers who entered too early. Now, notice what happens next. The price reverses and closes back above the support level. That's your liquidity sweep confirmation. This move signals that the pullback is likely over and the uptrend is about to continue. Now let's apply this concept to a trend line in a downtrend. As you can see, there's a clean trend line connecting the lower highs.